B22 An entity's promise to stand ready to accept a return product during the return period shall not be accounted for as a performance obligation in addition to the obligation to provide a refund. B23 An entity shall apply the requirements in paragraphs 47 to 72, including the requirements for constraining estimates of variable consideration in paragraphs 56 to 58, to determine the amount of consideration to which the entity expects to be entitled, i.e. excluding the products expected to be returned. For any amounts received or receivable, for which an entity does not expect to be entitled, the entity shall not recognize revenue when it transfers products to customers but shall recognize those amounts received, or receivable, as a refund liability. Subsequently, at the end of each reporting period, the entity shall update its assessment of amounts for which it expects to be entitled in exchange for the transferred products and make a corresponding change to the transaction price and therefore, in the amount of revenue recognized. B24 An entity shall update the measurement of the refund liability at the end of each reporting period for changes in expectations about the amount of refunds. An entity shall recognize corresponding adjustments as revenue, or reductions of revenue. B25 An asset recognized for an entity's right to recover products from a customer on settling a refund liability shall initially be measured by reference to the former carrying amount of the product, for example inventory, less any expected costs to recover those products, including potential decreases in the value to the entity of returned products. At the end of each reporting period, an entity shall update the measurement of the asset arising from changes in expectations about products to be returned. An entity shall present the assets separately from the refund liability. B26 Exchanges by customers of one product for another of the same type, quality, condition and price, for example, one color or size for another, are not considered returns for the purposes of applying this standard. B27 Contracts in which a customer may return a defective product in exchange for a functioning product shall be evaluated in accordance with the guidance on warranties in paragraphs B28, B33. Warranties. B28 It is common for an entity to provide, in accordance with the contract, the law or the entity's customary business practices, a warranty in connection with the sale of a product, whether a good or service. The nature of a warranty can vary significantly across industries and contracts. Some warranties provide a customer with assurance that the related product will function as the parties intended because it complies with agreed-upon specifications. Other warranties provide the customer with a service in addition to the assurance that the product complies with agreed-upon specifications. B29 If a customer has the option to purchase a warranty separately, for example because the warranty is priced or negotiated separately, the warranty is a distinct service because the entity promises to provide the service to the customer in addition to the product that has the functionality described in the contract. In those circumstances, an entity shall account for the promised warranty as a performance obligation in accordance with paragraphs 22 to 30 and allocate a portion of the transaction price to that performance obligation in accordance with paragraphs 73 to 86. B30 If a customer does not have the option to purchase a warranty separately, an entity shall account for the warranty in accordance with LKS 37 provisions, contingent liabilities and contingent assets unless the promised warranty, or a part of the promised warranty, provides the customer with a service in addition to the assurance that the product complies with agreed-upon specifications. B31 In assessing whether a warranty provides a customer with a service in addition to the assurance that the product complies with agreed-upon specifications, an entity shall consider factors such as a. Whether the warranty is required by law. If the entity is required by law to provide a warranty, the existence of that law indicates that the promised warranty is not a performance obligation because such requirements typically exist to protect customers from the risk of purchasing defective products. B. The length of the warranty coverage period. The longer the coverage period, the more likely it is that the promised warranty is a performance obligation because it is more likely to provide a service in addition to the assurance that the product complies with agreed-upon specifications. C. The nature of the tasks that the entity promises to perform. If it is necessary for an entity to perform specified tasks to provide the assurance that a product complies with agreed-upon specifications, for example, a return shipping service for a defective product, then those tasks likely do not give rise to a performance obligation. B32 If a warranty, or a part of a warranty, provides a customer with a service in addition to the assurance that the product complies with agreed-upon specifications, the promised service is a performance obligation. Therefore, an entity shall allocate the transaction price to the product and the service. If an entity promises both an assurance-type warranty and a service-type warranty but cannot reasonably account for them separately, the entity shall account for both of the warranties together as a single performance obligation. B33A law that requires an entity to pay compensation if its products cause harm or damage does not give rise to a performance obligation. For example, a manufacturer might sell products in a jurisdiction in which the law holds the manufacturer liable for any damages, for example, to personal property, that might be caused by a consumer using a product for its intended purpose. Similarly, an entity's promise to indemnify the customer for liabilities and damages arising from claims of patent, copyright, trademark or other infringement by the entity's products does not give rise to a performance obligation. The entity shall account for such obligations in accordance with LKAS 37. Principal versus agent considerations. B34 When another party is involved in providing goods or services to a customer, the entity shall determine whether the nature of its promise is a performance obligation to provide the specified goods or services itself, i.e. the entity is a principal, or to arrange for those goods or services to be provided by the other party, i.e. the entity is an agent. An entity determines whether it is a principal or an agent for each specified good or service promised to the customer. A specified good or service is a distinct good or service, or a distinct bundle of goods or services, to be provided to the customer. See paragraphs 27 to 30. If a contract with a customer includes more than one specified good or service, an entity could be a principal for some specified goods or services and an agent for others. B34A To determine the nature of its promise, as described in paragraph B34, the entity shall a. Identify the specified goods or services to be provided to the customer, which for example could be a right to a good or service, to be provided by another party, see paragraph 26, and b. Assess whether it controls, as described in paragraph 33, each specified good or service before that good or service is transferred to the customer. B35 An entity is a principal if it controls the specified good or service before that good or service is transferred to a customer. However, an entity does not necessarily control a specified good if the entity obtains legal title to that good only momentarily before legal title is transferred to a customer. An entity that is a principal may satisfy its performance obligation to provide the specified good or service itself, or it may engage another party, for example a subcontractor, to satisfy some or all of the performance obligation on its behalf. B35A When another party is involved in providing goods or services to a customer, an entity that is a principal obtains control of any one of the following. A good or another asset from the other party that it then transfers to the customer. B. A right to a service to be performed by the other party, which gives the entity the ability to direct that party to provide the service to the customer on the entity's behalf. C. A good or service from the other party that it then combines with other goods or services in providing the specified good or service to the customer. For example, if an entity provides a significant service of integrating goods or services, see paragraph 29A, provided by another party into the specified good or service for which the customer has contracted, the entity controls the specified good or service before that good or service is transferred to the customer. This is because the entity first obtains control of the inputs to the specified good or service, which includes goods or services from other parties, and directs their use to create the combined output that is the specified good or service. B35B When or as an entity that is a principal satisfies a performance obligation, the entity recognizes revenue in the gross amount of consideration to which it expects to be entitled in exchange for the specified good or service transferred. B36 An entity is an agent if the entity's performance obligation is to arrange for the provision of the specified good or service by another party. An entity that is an agent does not control the specified good or service provided by another party before that good or service is transferred to the customer. When or as an entity that is an agent satisfies a performance obligation, the entity recognizes revenue in the amount of any fee or commission to which it expects to be entitled in exchange for arranging for the specified goods or services to be provided by the other party. An entity's fee or commission might be the net amount of consideration that the entity retains after paying the other party the consideration received in exchange for the goods or services to be provided by that party. B37 Indicators that an entity controls the specified good or service before it is transferred to the customer, and is therefore a principal, see paragraph B35, include but are not limited to the following. A. The entity is primarily responsible for fulfilling the promise to provide the specified good or service. This typically includes responsibility for the acceptability of the specified good or service, for example, primary responsibility for the good or service meeting customer specifications. If the entity is primarily responsible for fulfilling the promise to provide the specified good or service, This may indicate that the other party involved in providing the specified good or service is acting on the entity's behalf. B. The entity has inventory risk before the specified good or service has been transferred to a customer or after transfer of control to the customer, for example, if the customer has a right of return. For example, if the entity obtains or commits itself to obtain the specified good or service before obtaining a contract with a customer, that may indicate that the entity has the ability to direct the use of and obtain substantially all of the remaining benefits from the good or service before it is transferred to the customer. C. The entity has discretion in establishing the price for the specified good or service. Establishing the price that the customer pays for the specified good or service may indicate that the entity has the ability to direct the use of that good or service and obtain substantially all of the remaining benefits. However, an agent can have discretion in establishing prices in some cases. For example, an agent may have some flexibility in setting prices in order to generate additional revenue from its service of arranging for goods or services to be provided by other parties to customers. B37A. The indicators in paragraph B37 may be more or less relevant to the assessment of control depending on the nature of the specified good or service and the terms and conditions of the contract. In addition, different indicators may provide more persuasive evidence in different contracts. B38. If another entity assumes the entity's performance obligations and contractual rights in the contract so that the entity is no longer obliged to satisfy the performance obligation to transfer the specified good or service to the customer, i.e. the entity is no longer acting as the principal, the entity shall not recognize revenue for that performance obligation. Instead, the entity shall evaluate whether to recognize revenue for satisfying a performance obligation to obtain a contract for the other party, i.e. whether the entity is acting as an agent. Customer options for additional goods or services. B39. Customer options to acquire additional goods or services for free or at a discount come in many forms, including sales incentives, customer award credits or points, contract renewal options or other discounts on future goods or services. B40. If, in a contract, an entity grants a customer the option to acquire additional goods or services, that option gives rise to a performance obligation in the contract only if the option provides a material right to the customer that it would not receive without entering into that contract. For example, a discount that is incremental to the range of discounts typically given for those goods or services to that class of customer in that geographical area or market. If the option provides a material right to the customer in effect pays the entity in advance for future goods or services and the entity recognizes revenue when those future goods or services are transferred or when the option expires. B41. If a customer has the option to acquire an additional good or service at a price that would reflect the standalone selling price for that good or service, that option does not provide the customer with a material right even if the option can be exercised only by entering into a previous contract. In those cases, the entity has made a marketing offer that it shall account for in accordance with this standard only when the customer exercises the option to purchase the additional goods or services. B42. Paragraph 74 requires an entity to allocate the transaction price to performance obligations on a relative standalone selling price basis. If the standalone selling price for a customer's option to acquire additional goods or services is not directly observable, an entity shall estimate it. That estimate shall reflect the discount that the customer would obtain when exercising the option, adjusted for both of the following. A. Any discount that the customer could receive without exercising the option, and B. The likelihood that the option will be exercised. B43. If a customer has a material right to acquire future goods or services and those goods or services are similar to the original goods or services in the contract and are provided in accordance with the terms of the original contract, then an entity may, as a practical alternative to estimating the standalone selling price of the option, allocate the transaction price to the optional goods or services by reference to the goods or services expected to be provided and the corresponding expected consideration. Typically, those types of options are for contract renewals. Customers' unexercised rights. B44. In accordance with paragraph 106, upon receipt of a prepayment from a customer, an entity shall recognize a contract liability in the amount of the prepayment for its performance obligation to transfer, or to stand ready to transfer, goods or services in the future. An entity shall recognize that contract liability and recognize revenue, when it transfers those goods or services and therefore, satisfies its performance obligation. B45. A customer's non-refundable prepayment to an entity gives the customer a right to receive a good or service in the future, and obliges the entity to stand ready to transfer a good or service. However, customers may not exercise all of their contractual rights. Those unexercised rights are often referred to as breakage. B46 If an entity expects to be entitled to a breakage amount in a contract liability, the entity shall recognize the expected breakage amount as revenue in proportion to the pattern of rights exercised by the customer. If an entity does not expect to be entitled to a breakage amount, the entity shall recognize the expected breakage amount as revenue when the likelihood of the customer exercising its remaining rights becomes remote. To determine whether an entity expects to be entitled to a breakage amount, the entity shall consider the requirements in paragraphs 56 to 58 on constraining estimates of variable consideration. B47 An entity shall recognize a liability, and not revenue, for any consideration received that is attributable to a customer's unexercised rights for which the entity is required to remit to another party, for example, a government entity in accordance with applicable unclaimed property laws. Non-refundable upfront fees and some related costs. B48 In some contracts, an entity charges a customer a non-refundable upfront fee at or near contract inception. Examples include joining fees in health club membership contracts, activation fees in telecommunication contracts, setup fees in some services contracts and initial fees in some supply contracts. B49 To identify performance obligations in such contracts, an entity shall assess whether the fee relates to the transfer of a promised good or service. In many cases, even though a non-refundable upfront fee relates to an activity that the entity is required to undertake at or near contract inception to fulfill the contract, that activity does not result in the transfer of a promised good or service to the customer. See paragraph 25. Instead, the upfront fee is an advance payment for future goods or services and therefore, would be recognized as revenue when those future goods or services are provided. The revenue recognition period would extend beyond the initial contractual period if the entity grants the customer the option to renew the contract and that option provides the customer with a material right as described in paragraph B40. B50 If the non-refundable upfront fee relates to a good or service, the entity shall evaluate whether to account for the good or service as a separate performance obligation in accordance with paragraphs 22 to 30. B51 An entity may charge a non-refundable fee in part as compensation for costs incurred in setting up a contract, or other administrative tasks as described in paragraph 25. If those setup activities do not satisfy a performance obligation, the entity shall disregard those activities and related costs when measuring progress in accordance with paragraph B19. That is because the costs of setup activities do not depict the transfer of services to the customer. The entity shall assess whether costs incurred in setting up a contract have resulted in an asset that shall be recognized in accordance with paragraph 95. Licensing. B52 A license establishes a customer's rights to the intellectual property of an entity. Licenses of intellectual property may include, but are not limited to, licenses of any of the following: A. Software and technology. B. Motion pictures, music and other forms of media and entertainment. C. Franchises. And D. Patents, trademarks and copyrights. B53 In addition to a promise to grant a license or licenses to a customer, an entity may also promise to transfer other goods or services to the customer. Those promises may be explicitly stated in the contract or implied by an entity's customary business practices, published policies or specific statements. See paragraph 24. As with other types of contracts, when a contract with a customer includes a promise to grant a license or licenses, in addition to other promised goods or services, an entity applies paragraphs 22 to 30 to identify each of the performance obligations in the contract. B54 If the promise to grant a license is not distinct from other promised goods or services in the contract in accordance with paragraphs 26 to 30, an entity shall account for the promise to grant a license and those other promised goods or services together as a single performance obligation. Examples of licenses that are not distinct from other goods or services promised in the contract include the following. A. A license that forms a component of a tangible good and that is integral to the functionality of the good. And B. A license that the customer can benefit from only in conjunction with a related service, such as an online service provided by the entity that enables, by granting a license, the customer to access content. B55 If the license is not distinct, an entity shall apply paragraphs 31 to 38 to determine whether the performance obligation, which includes the promised license, is a performance obligation that is satisfied over time or satisfied at a point in time. B56 If the promise to grant the license is distinct from the other promised goods or services in the contract and therefore the promise to grant the license is a separate performance obligation, an entity shall determine whether the license transfers to a customer either at a point in time or over time. In making this determination, an entity shall consider whether the nature of the entity's promise in granting the license to a customer is to provide the customer with either a right to access the entity's intellectual property as it exists throughout the license period, or b. a right to use the entity's intellectual property as it exists at the point in time at which the license is granted. Determining the nature of the entity's promise. B57, deleted. B58, the nature of an entity's promise in granting a license is a promise to provide a right to access the entity's intellectual property if all of the following criteria are met. A. The contract requires or the customer reasonably expects that the entity will undertake activities that significantly affect the intellectual property to which the customer has rights. See paragraphs B59 and B59A. B. The rights granted by the license directly expose the customer to any positive or negative effects of the entity's activities identified in paragraph B58A. And C. Those activities do not result in the transfer of a good or a service to the customer as those activities occur. See paragraph 25. B59 factors that may indicate that a customer could reasonably expect that an entity will undertake activities that significantly affect the intellectual property include the entity's customary business practices, published policies or specific statements. Although not determinative, the existence of a shared economic interest, for example, a sales-based royalty, between the entity and the customer related to the intellectual property to which the customer has rights may also indicate that the customer could reasonably expect that the entity will undertake such activities. B59A, an entity's activities significantly affect the intellectual property to which the customer has rights when either a. Those activities are expected to significantly change the form, for example, the design or content, or the functionality, for example, the ability to perform a function or task, of the intellectual property, or b. The ability of the customer to obtain benefit from the intellectual property is substantially derived from or dependent upon those activities. For example, the benefit from a brand is often derived from or dependent upon the entity's ongoing activities that support or maintain the value of the intellectual property. Accordingly, if the intellectual property to which the customer has rights has significant standalone functionality, a substantial portion of the benefit of that intellectual property is derived from that functionality. Consequently, the ability of the customer to obtain benefit from that intellectual property would not be significantly affected by the entity's activities unless those activities significantly change its form or functionality. Types of intellectual property that often have significant standalone functionality include software, biological compounds or drug formulas, and completed media content, for example, films, television shows and music recordings. B60, if the criteria in paragraph B58 are met, an entity shall account for the promise to grant a license as a performance obligation satisfied over time because the customer will simultaneously receive and consume the benefit from the entity's performance of providing access to its intellectual property as the performance occurs. See paragraph 35A. An entity shall apply paragraphs 39 to 45 to select an appropriate method to measure its progress towards complete satisfaction of that performance obligation to provide access. B61, if the criteria in paragraph B58 are not met, the nature of an entity's promise is to provide a right to use the entity's intellectual property as that intellectual property exists, in terms of form and functionality, at the point in time at which the license is granted to the customer. This means that the customer can direct the use of, and obtain substantially all of the remaining benefits from, the license at the point in time at which the license transfers. An entity shall account for the promise to provide a right to use the entity's intellectual property as a performance obligation satisfied at a point in time. An entity shall apply paragraph 38 to determine the point in time at which the license transfers to the customer. However, revenue cannot be recognized for a license that provides a right to use the entity's intellectual property before the beginning of the period during which the customer is able to use and benefit from the license. For example, if a software license period begins before an entity provides or otherwise makes available to the customer a code that enables the customer to immediately use the software, the entity would not recognize revenue before that code has been provided or otherwise made available. B62, an entity shall disregard the following factors when determining whether a license provides a right to access the entity's intellectual property or a right to use the entity's intellectual property. A. Restrictions of time, geographical region or use. Those restrictions define the attributes of the promised license, rather than define whether the entity satisfies its performance obligation at a point in time or over time. B. Guarantees provided by the entity that it has a valid patent to intellectual property and that it will defend that patent from unauthorized use. A promise to defend a patent right is not a performance obligation because the act of defending a patent protects the value of the entity's intellectual property assets and provides assurance to the customer that the license transferred meets the specifications of the license promised in the contract. Sales-based or usage-based royalties. B63 Notwithstanding the requirements in paragraphs 56 to 59, an entity shall recognize revenue for a sales-based or usage-based royalty promised in exchange for a license of intellectual property only when or as the later of the following events occurs. A. The subsequent sale or usage occurs, and B. The performance obligation to which some or all of the sales-based or usage-based royalty has been allocated has been satisfied, or partially satisfied. B63A. The requirement for a sales-based or usage-based royalty in paragraph B63 applies when the royalty relates only to a license of intellectual property or when a license of intellectual property is the predominant item to which the royalty relates. For example, the license of intellectual property may be the predominant item to which the royalty relates when the entity has a reasonable expectation that the customer would ascribe significantly more value to the license than to the other goods or services to which the royalty relates. B63B. When the requirement in paragraph B63A is met, revenue from a sales-based or usage-based royalty shall be recognized wholly in accordance with paragraph B63. When the requirement in paragraph B63A is not met, the requirements on variable consideration in paragraphs 50 to 59 apply to the sales-based or usage-based royalty. Repurchase agreements. B64A. Repurchase agreement is a contract in which an entity sells an asset and also promises or has the option, either in the same contract or in another contract, to repurchase the asset. The repurchased asset may be the asset that was originally sold to the customer, an asset that is substantially the same as that asset, or another asset of which the asset that was originally sold is a component. B65 repurchase agreements generally come in three forms. A. An entity's obligation to repurchase the asset, a forward. B. An entity's right to repurchase the asset, a call option. And C. An entity's obligation to repurchase the asset at the customer's request, a put option. A forward or a call option. B66 If an entity has an obligation or a right to repurchase the asset, a forward or a call option, a customer does not obtain control of the asset because the customer is limited in its ability to direct the use of, and obtain substantially all of the remaining benefits from, the asset even though the customer may have physical possession of the asset. Consequently, the entity shall account for the contract as either of the following. A. A lease in accordance with SLFRS 16 leases if the entity can or must repurchase the asset for an amount that is less than the original selling price of the asset, unless the contract is part of a sale and leaseback transaction. If the contract is part of a sale and leaseback transaction, the entity shall continue to recognize the asset and shall recognize a financial liability for any consideration received from the customer. The entity shall account for the financial liability in accordance with SLFRS 9, or B. A financing arrangement in accordance with paragraph B68 if the entity can or must repurchase the asset for an amount that is equal to or more than the original selling price of the asset. B67 When comparing the repurchase price with the selling price, an entity shall consider the time value of money. B68 If the repurchase agreement is a financing arrangement, the entity shall continue to recognize the asset and also recognize a financial liability for any consideration received from the customer. The entity shall recognize the difference between the amount of consideration received from the customer and the amount of consideration to be paid to the customer as interest and, if applicable, as processing or holding costs, for example, insurance. B69 If the option lapses unexercised, an entity shall recognize the liability and recognize revenue. A put option. B70 If an entity has an obligation to repurchase the asset at the customer's request, a put option, at a price that is lower than the original selling price of the asset, the entity shall consider at contract inception whether the customer has a significant economic incentive to exercise that right. The customer's exercising of that right results in the customer effectively paying the entity consideration for the right to use a specified asset for a period of time. Therefore, if the customer has a significant economic incentive to exercise that right, the entity shall account for the agreement as a lease in accordance with SLFRS 16. Unless the contract is part of a sale and leaseback transaction. If the contract is part of a sale and leaseback transaction, the entity shall continue to recognize the asset and shall recognize a financial liability for any consideration received from the customer. The entity shall account for the financial liability in accordance with SLFRS 9. B71 to determine whether a customer has a significant economic incentive to exercise its right. An entity shall consider various factors, including the relationship of the repurchase price to the expected market value of the asset at the date of the repurchase and the amount of time until the right expires. For example, if the repurchase price is expected to significantly exceed the market value of the asset, this may indicate that the customer has a significant economic incentive to exercise the put option. B72 if the customer does not have a significant economic incentive to exercise its right at a price that is lower than the original selling price of the asset, the entity shall account for the agreement as if it were the sale of a product with a right of return as described in paragraphs B20 e B27. B73 if the repurchase price of the asset is equal to or greater than the original selling price and is more than the expected market value of the asset, the contract is in effect a financing arrangement and therefore shall be accounted for as described in paragraph B68. B74 if the repurchase price of the asset is equal to or greater than the original selling price and is less than or equal to the expected market value of the asset, and the customer does not have a significant economic incentive to exercise its right, then the entity shall account for the agreement as if it were the sale of a product with a right of return as described in paragraphs B20, B27. B75 when comparing the repurchase price with the selling price, an entity shall consider the time value of money. B76 if the option lapses unexercised, an entity shall recognize the liability and recognize revenue. Consignment arrangements. B77 when an entity delivers a product to another party, such as a dealer or a distributor, for sale to end customers, the entity shall evaluate whether that other party has obtained control of the product at that point in time. A product that has been delivered to another party may be held in a consignment arrangement if that other party has not obtained control of the product. Accordingly, an entity shall not recognize revenue upon delivery of a product to another party if the delivered product is held on consignment. B78 indicators that an arrangement is a consignment arrangement include, but are not limited to, the following. A. The product is controlled by the entity until a specified event occurs, such as the sale of the product to a customer of the dealer or until a specified period expires. B. The entity is able to require the return of the product or transfer the product to a third party, such as another dealer. And C. The dealer does not have an unconditional obligation to pay for the product, although it might be required to pay a deposit. Bill and hold arrangements. B79 A bill and hold arrangement is a contract under which an entity bills a customer for a product, but the entity retains physical possession of the product until it is transferred to the customer at a point in time in the future. For example, a customer may request an entity to enter into such a contract because of the customer's lack of available space for the product or because of delays in the customer's production schedules. B80 An entity shall determine when it has satisfied its performance obligation to transfer a product by evaluating when a customer obtains control of that product. See paragraph 38. For some contracts, control is transferred either when the product is delivered to the customer's site or when the product is shipped, depending on the terms of the contract, including delivery and shipping terms. However, for some contracts, a customer may obtain control of a product even though that product remains in an entity's physical possession. In that case, the customer has the ability to direct the use of, and obtain substantially all of the remaining benefits from, the product even though it has decided not to exercise its right to take physical possession of that product. Consequently, the entity does not control the product. Instead, the entity provides custodial services to the customer over the customer's asset. B81 In addition to applying the requirements in paragraph 38, for a customer to have obtained control of a product in a bill and hold arrangement, all of the following criteria must be met. A. The reason for the bill and hold arrangement must be substantive, for example, the customer has requested the arrangement. B. The product must be identified separately as belonging to the customer. C. The product currently must be ready for physical transfer to the customer. And D. The entity cannot have the ability to use the product or to direct it to another customer. B89 Examples of categories that might be appropriate include, but are not limited to, all of the following. A. Type of good or service, for example, major product lines. B. Geographical region, for example, country or region. C. Market or type of customer, for example, government and non-government customers. D. Type of contract, for example, fixed price and time and materials contracts. E. Contract duration, for example, short-term and long-term contracts. F. Timing of transfer of goods or services, for example, revenue from goods or services transferred to customers at a point in time, and revenue from goods or services transferred over time, and G. Sales channels, for example, goods sold directly to consumers and goods sold through intermediaries. Appendix C. Effective date and transition. This appendix is an integral part of the standard and has the same authority as the other parts of the standard. Effective date. C1. An entity shall apply this standard for annual reporting periods beginning on or after January 1, 2018. Earlier application is permitted. If an entity applies this standard earlier, it shall disclose that fact. C1. SLFRS 16 leases, issued in April 2016, amended paragraphs 597, B66 and B70. An entity shall apply those amendments when it applies SLFRS 16. C1b. Clarifications to SLFRS 15 revenue from contracts with customers, issued in October 2016, amended paragraphs 26, 27, 29, B1, B34, B38, B52, B53, B58, C2, C5 and C7, deleted paragraph B57 and added paragraphs B34A, B35A, B35B, B37A, B59A, B63A, B63B, C7A and C8A. An entity shall apply those amendments for annual reporting periods beginning on or after January 1, 2018. Earlier application is permitted. If an entity applies those amendments for an earlier period, it shall disclose that fact. C1c. This paragraph refers to amendments that are not yet effective, and is therefore not included in this edition. Transition. C2. For the purposes of the transition requirements in paragraphs C3, C8a. A. The date of initial application is the start of the reporting period in which an entity first applies this standard, and B. A completed contract is a contract for which the entity has transferred all of the goods or services identified in accordance with LKAS 11 construction contracts, LKAS 18 revenue and related interpretations. C3. An entity shall apply this standard using one of the following two methods. A. Retrospectively to each prior reporting period presented in accordance with LKAS 8 accounting policies, changes in accounting estimates and errors, subject to the expedients in paragraph C5, or B. Retrospectively with the cumulative effect of initially applying this standard recognized at the date of initial application in accordance with paragraphs C7, C8. C4. Notwithstanding the requirements of paragraph 28 of LKAS 8, when this standard is first applied, an entity need only present the quantitative information required by paragraph 28, F, of LKAS 8 for the annual period immediately preceding the first annual period for which this standard is applied, the immediately preceding period. And only if the entity applies this standard retrospectively in accordance with paragraph C3a. An entity may also present this information for the current period or for earlier comparative periods, but is not required to do so. C5. An entity may use one or more of the following practical expedients when applying this standard retrospectively in accordance with paragraph C3a. A. For completed contracts, an entity need not restate contracts that I. Begin and end within the same annual reporting period, or 2. Are completed contracts at the beginning of the earliest period presented. B. For completed contracts that have variable consideration, an entity may use the transaction price at the date the contract was completed rather than estimating variable consideration amounts in the comparative reporting periods. C. For contracts that were modified before the beginning of the earliest period presented, an entity need not retrospectively restate the contract for those contract modifications in accordance with paragraphs 20 to 21. Instead, an entity shall reflect the aggregate effect of all of the modifications that occur before the beginning of the earliest period presented when I. Identifying the satisfied and unsatisfied performance obligations. 2. Determining the transaction price. And 3. Allocating the transaction price to the satisfied and unsatisfied performance obligations. D. For all reporting periods presented before the date of initial application, an entity need not disclose the amount of the transaction price allocated to the remaining performance obligations and an explanation of when the entity expects to recognize that amount as revenue. See paragraph 120. C6. For any of the practical expedients in paragraph C5 that an entity uses, the entity shall apply that expedient consistently to all contracts within all reporting periods presented. In addition, the entity shall disclose all of the following information: A. The expedients that have been used, and B. To the extent reasonably possible, a qualitative assessment of the estimated effect of applying each of those expedients. C7. If an entity elects to apply this standard retrospectively in accordance with paragraph C3b, the entity shall recognize the cumulative effect of initially applying this standard as an adjustment to the opening balance of retained earnings, or other component of equity as appropriate, of the annual reporting period that includes the date of initial application. Under this transition method, an entity may elect to apply this standard retrospectively only to contracts that are not completed contracts at the date of initial application. For example, January 1, 2018 for an entity with a December 31 year-end. C7a. An entity applying this standard retrospectively in accordance with paragraph C3b may also use the practical expedient described in paragraph C5c, either A. For all contract modifications that occur before the beginning of the earliest period presented, or B. For all contract modifications that occur before the date of initial application. If an entity uses this practical expedient, the entity shall apply the expedient consistently to all contracts and disclose the information required by paragraph C6. C8. For reporting periods that include the date of initial application, an entity shall provide both of the following additional disclosures if this standard is applied retrospectively in accordance with paragraph C3b. A. The amount by which each financial statement line item is affected in the current reporting period by the application of this standard as compared to LKS 11, LKS 18 and related interpretations that were in effect before the change, and B. An explanation of the reasons for significant changes identified in C8a. C8a. An entity shall apply clarifications to SLFRS 15, see paragraph C1b, retrospectively in accordance with LKS 8. In applying the amendments retrospectively, an entity shall apply the amendments as if they had been included in SLFRS 15 at the date of initial application. Consequently, an entity does not apply the amendments to reporting periods or to contracts to which the requirements of SLFRS 15 are not applied in accordance with paragraphs C2, C8. For example, if an entity applies SLFRS 15 in accordance with paragraph C3b, only to contracts that are not completed contracts at the date of initial application, the entity does not restate the completed contracts at the date of initial application of SLFRS 15 for the effects of these amendments. References to SLFRS 9. C9. If an entity applies this standard but does not yet apply SLFRS 9 financial instruments, any reference in this standard to SLFRS 9 shall be read as a reference to LKS 39 financial instruments. Recognition and measurement. Withdrawal of other standards. C10. This standard supersedes the following standards. A. LKS 11 construction contracts. B. LKS 18 revenue. C. IFRIC 13 customer loyalty programs. D. IFRIC 15 agreements for the construction of real estate. E. IFRIC 18 transfers of assets from customers. And F. SIC 31 revenue, barter transactions involving advertising services.